Okay, so we're going to talk about multiple topics today, but the first thing I want to talk about, because it's like the basis of everything, really, and it has to do with the time value of money. And basically, you know, what is an interest rate? You know what I mean? What is an interest rate, right?
Price of money.
Yeah, it's the price of money, you know? And, but I mean, more fundamentally, right? You know, if you think about, okay, what's $1,000? Would you rather have $1,000 now, right? Or would you rather have it in 2 years?
Now.
Depending on the
Right.
ROI.
Well, any interest rate, right? No matter what the interest rate, right? You should choose the $1,000 now as this is a term in finance called the future present value, right? Of $1,000. The present value of $1,000 from 2 years, like, is a lot less than $1,000. Okay, because you have to wait.
Changes with time. Inflation.
Not only inflation, but the time value of money. All right, the risk-free rate of interest. Say it's 3%, right? Which we're going to say is definitely over inflation, and it might not be, but so you have to discount this amount by this much, and say it's in 2 years, I don't know, say it's like $950. That's not an exact calculation. So this is how you can measure, whether or not you should choose this or that, right? And, because basically an interest rate is basically, when somebody foregoes current consumption for future consumption. The only reason they would do that is because they're getting more in 2 years than they are now. Or yeah.
How do you know what it's going to be in 2 years? Is there like a way to calculate that?
How do I know what is?
Because like you said, like what if it's 950 in 2 years? How would you calculate that it's going to be 950 in 2 years?
Because you discount it. It's like an interest rate, right? Like a compounding interest rate.
Okay.
But it's negative. It's a discount rate.
Gotcha.
Okay. So instead of like, remember PERT, P-E-R-T, you know how E-R to the T, right? That's a compounding factor to the principal. Okay. Well, when you talk about a discounting factor, this would be negative.
Oh, okay.
Simple, right? So that would be the discounting factor, all right? And some of this, when we talk about options, pricing and all that, like you have to kind of understand discounting, But, and anyway, the biggest thing with the interest rate is, it's an aggregate view of the risk of a particular asset, And when they talk about the risk-free rate of interest, they're really talking about U.S. bonds because it's not really risk-free, but it kind of has to be in the sense that if it's not and the United States goes bust, everything is done. You know what I mean? So, so they define that. Yeah, we don't want to experience that. That's like they say, don't ever trade for the end of the world because that only happens once. You know what I mean?
Wow, deep. That's pretty cool. I've never heard that. That's all like that.
Yeah. So, so basically the interest rate is like an aggregate view of the risk of a particular instrument, right? And fundamentally it really means like all these people are deciding not to consume right now and they're going to decide to consume in the future, and that's their price on their foregone consumption, And it should be. Obviously the government interferes with interest rates and stuff, but particularly on a free market object, that's what it would be, So anyway, that particular aspect is super important because, buried in every transaction, just like, when you think about petroleum as in plastics and all that, is the cost, the time value of money. And, as it changes, it can change the entire economy, and in your decision-making process, it also should make a difference. So anyway, today that was one thing I wanted to get at is that, interest rate isn't just a charge, that's charged at a, credit card necessarily. It's foregone consumption. Somebody has to lend that money and forego doing something with it right now. And that's the price they're charging you.
Price of money.
Yeah, the price and time value of money.
What interest rate is the most important one in your opinion? Like the 2-year, 5-year, 10-year, 30-year rates? Like what is, in your opinion, like what is?
Well, it just really depends upon your time horizon. Most important, like with respect to what, though? You know what I mean?
It seems like the 10 years looked at more than other rates. Is there like a reason for that? Is because
Yeah. I don't know. I don't know. I don't know enough about bonds and interest rates. I've looked into it a little bit, and
If
basically,
you're like making big investments, then you really have to plan for the future, right? It's like, like what banks do with certain like properties and stuff on like, intercoastals and things like that. They plan for 10 years ahead, so obviously they're gonna have to look at stuff like that, right?
right. So there's interest rate futures, right?
Right.
There's nothing you can control, so how would you plan?
And there's an expiration at each month or something, and this guy comes out and says, well, I don't want the interest rate to go up or down for me, for this project I'm going to develop out in the future. So, and I need to base my entire business model on a definite number. So I'm going to take this interest rate by buying this future, right? And so I lock myself in at like 3%. So I mean, now I'm in the futures hedging off my risk, and I no longer have to worry about whether or not the interest rate's going to go way up or down. I now have stabilized my business. Now someone else on the other side of that trade, might do something else. They might, since they sold me this, they might buy and sell. They might buy the adjacent months to hedge off that risk and not take price level risk, because this, one thing about it is this is actually from math too. It's Pascal's triangle. You guys remember that? 1, 2, 1, 1, 3, 3, 1, 1, 4, 6, 4, 1. Well, when you trade futures, these are structures that you use to isolate particular parts of a futures curve without taking the price risk. What I mean by the price level risk is like if you have a future, like an interest rate future, and if you graphed one single expiry, it might look like this, you know what I mean? But then if you graph, one expiry, like just this is January, this is February, this is March. Say you sold that and you bought that. Well, it's not going to look all wild anymore. It might look like this. You know what I mean? The difference between the two. You're selling this and buying that. It reduces the volatility of the structure. And then say you put on another spread like this. You see how this is 1 January, 2 February, 1 March. It looks familiar, right? So now you get farther away from taking the risk of an individual month, and that's what if somebody was, in the future, and say the futures curve looked real funny for some reason because there was a huge demand in one product, you might put a what they call, this is a butterfly on this position, and you wouldn't be subject to so much of the price risk associated with one leg.
It's called a butterfly?
Yeah, that's a butterfly.
Oh, it's just
because there's meat right here where you have two positions, right? +2, -1, -1. So they just call that the meat of the butterfly, and these the wings.
Oh, gotcha. Okay.
You know what I'm saying? So yeah. So basically, some of the future strategies use the same nomenclature as the option strategies, because there's an option strategy called a butterfly too. So anyway, the bottom line is you keep going, you'll realize how much the math actually plays into stuff that you do, So the other thing is, remember we talked about, a derivative, right? So we have x squared as our position function. So, what's the derivative of x squared? 2x. What's the second derivative? 2. So what do these graphs look like, right? This should go something like this, at least on the positive side. And then, we know that this is the slope of the tangent line, right? At least Daniel will tell you that. But graph this individually, right? It looks like this, right? And then this one, right, looks just like this. There's really no change in this, So this is like a first order derivative to the position function. Basic, super basic math, If you don't know that, I guarantee you didn't get through calculus. Okay, so when we graph, what we did last week, we graphed like the payoff structure of a call option, okay? And this was, we're going to use some examples, you know, that I found that I really like, okay? So this is here, and then where am I at? Okay, it goes to 40, and then it cuts up. And this means you're down $200. So this is at expiration, okay? It's going to look different before expiration, you know? You put the position on, your strike price is 40, right? There's 40 right here. You know, you're not going to lose the $200 right away, right? There's going to be a value associated with this for a while. This will collapse over time with the influences of volatility and time. So anyway, at expiration, right? If it's at $40, you lose $200, you know? If it expires anywhere over $40, you're going to get some of your money back. And then there's a break-even point where you start making money, right? And this is just a very like super general idea of what right at expiration. You know, the life of the option, right, is going to look a lot different, because when you buy it, you know, and it goes up, you know, it's still worth money when you buy it, right? So the call option might go like this. You know, it might go straight up. Say the stock the next day jumps up a few points and then keeps going up and does like this. You don't have to wait to expiration and get rid of it. It's a super liquid market. All of a sudden, you know, you bought the call option for $5. No, it would be some multiple of 2. So say it was $2 times 100 is 200. You're down 200 if you lose it all. And it goes up, and immediately say you're up 50 cents, you know, so then it's worth $2.50. That could be the next day. It takes a while for the time value and for it to depreciate to the point where it's worth 0, because this is just expiration. And generally these graphs are to give you an idea of the behavior of the derivative. You know, this is a graph of the derivative, you know. So that's one strategy, a call option. But the other thing is, if you're on the other side of that trade, right, the graph should look completely the opposite, right? So I'm going to take a credit of $200, right? And I only really get to keep that credit if the option expires below $40. I'll get some portion of it if it expires below $45. You know, and obviously if the market opens tomorrow at $100, you know, I'm liable for, you know, this when you sell a put or you sell a call, this is actually a put. No, this is a call option. Yeah, it's a call option, because as the price goes up, your liability and your you go more in the negative. Question.
When you said like those graphs like that we were looking at, it's the derivative. What function is it a derivative of?
Yeah, you're talking about how you could describe a stock, the underlying instrument, as a function and then take its derivative. You know what I mean? And a stock price doesn't go in a straight line, or it's very, you know, it'd be hard to define something like that as a function, right? So this whole idea of pricing an option has everything to do with like instantaneous. It's an instantaneous view when you hold all the other variables constant, you know? And you know, and that's why this graph is only at expiration, when there are no longer influences on it. The price won't influence it. It's right at expiration, you know, period. So, and when we get into trying to price an option, you know, while before expiration, when there's still time left, that's where, you know, that Black-Scholes Merton model comes in, where it's a partial differential equation, which basically kind of has, you know, a probability factor, and it has, you know, the strike price, which is 40 here, the time element, and all that stuff, to come up with an idea, you know, based on probabilities, and historical volatility, which I'm going to show you the equation to that here in a minute. And it'll give you an idea what the call option should be worth. You know what I mean? Based on a partial differential equation, you know, that uses probability distribution and the factors of a strike price, you know, and the current price of the stock and all that. And we're going to get into that. But I just wanted to go over a few of these, you know, just so that, you know, it's in your mind, like, you know. So the puts are going to be similar, and then, you know, the one thing I wanted to show you is the straddle too, okay? So a straddle, right, is simply when you buy a call and a put at the same price. So if it's $40, right, you know, you don't make money unless you make the difference of the total two prices that you paid, which, you know, we're using 200, so you're down 400 right here to start, you know, and there's break-even points on either side, but this side you have to make up for the loss on that. You have to make up for the loss on the call, you know, if it goes down, and you have to make up for the loss on the put if it goes up, you know, and that's called a straddle.
So you're betting on a big move.
You're betting on a change, yeah, a big
One
move.
direction.
Yeah, in one direction.
So we don't know which. It's just you want a big
Yeah, you want a big move.
Sell a straddle, you're betting on low volatility, I guess, right?
Yeah, right. Or decrease in implied volatility. And that's where I wanted to pivot into this idea of volatility and historical volatility and implied volatility. So there's a simple equation that you guys did in statistics 1. It's basically standard deviation. But, you know, I don't know if you remember this, right?
Sigma.
Yeah.
Yeah.
And then you remember this crazy symbol?
The summation.
Yeah. And I equals 1. And R1 minus M squared, and then it's a over N minus 1, and then it's like that. Oh, yeah.
So what is that?
What's it look like?
I take stats. So.
What's it look like?
Standard deviation.
These are differences squared, right? So this is a sum.
Is that R1?
Yeah, that's R1.
Oh, that was R-com.
Okay.
That makes more sense.
Yeah. Surprised it makes sense at all.
It's RI, right? R sub I.
Yeah. With this one?
Yeah.
Yeah.
Yeah, R sub I. Yeah.
Yeah, because we're iterating by I in one step,
that's your
right?
data point, right?
Yeah.
And then your M is your mean.
Yeah, that's it. Your M is your mean.
A sample.
Yeah. M is an equation pretty simple, the mean, right? It's the differences.
Yeah.
It's the returns, actually. Wait, hold on. Yeah, it is exactly that. Why do I keep trying to do that? Daniel, can you write this for me? I'm just kidding.
What's that?
It's the returns divided by the number of returns. What's a return, right? So if the stock goes up 1 point, right? And it's a percentage change. This all has to do with percentage. So say it goes up 1%, then it goes down 2%, right? But that's negative, right? So then it goes up 4%, right? Well, you can see like the returns minus the mean squared makes it positive. You know, so this is really about magnitudes, right? Because that's what you're trying to get at, the variance or the standard deviation. So anyway, so you take the returns minus the mean, you square them, and you take the sum of all those, then you divide it by how many there are minus 1, and that gives you the standard deviation. Okay, and that basically, and then you normalize it. You know, usually volatility is always looked at in terms of time. Okay, and it changes. If you think about this, like, you know, you could have an extremely volatile stock, right? Oh, it's going nuts all the time, right? But then look, say we decided to measure from here to here, right? So our period never included all the variance in between, you know? So our you know, like all of a sudden it looks like, you know, we lost all this information. So it really, volatility is relative to the time period that you pick, you know? And basically, you know, they're 10-day, you know, periods or 20 or 30-day periods. But anyway, you'll use that, as an input to try to come up with the price of a call option. And the reason that you'd want to do that is because, you want to see, like this is going to be like all the calls, right? Say this is 100, this is 105, this is 110, this is 115, 95, 90, 85. And these are certain terms that you really need to know, okay? If the stock, right, is trading at 100 right now, everything from here down is what they would call in the money. It has intrinsic value. There is no, yeah, sure, if you bought an 85 call, right, it's going to be more than what? 100 minus 85 is 15. It's going to be more than $15, no doubt, because there's the time premium and all the probability of it going way up above has to be factored into the price. So the intrinsic value of buying a call option at 100 is $15, right? So everything above 100 is considered out of the money. Out of the money, OTM, common, and in the money, and then ATM. This is like, if you look up and you start reading, because the biggest thing about all this is you're gonna it's a whole new vocabulary, and you're, just like in a lot of other math stuff, it's like everything gets abbreviated, and I'm constantly like, I remember just constantly having to look back, like, what is this? What is that? What is this? So 100 is at the money, okay? And 110's out of the money. And as you can imagine, based on the volatility of this stock, like the variance, right? If you took what we were just doing, the standard deviation of all the moves, it's almost like turning this thing on its side in a way. And you look at it like, okay, 1% up, 2% down, 1% up, and say you annualize it over time and you get 20%, right? Just say, so you use a 10-day period, right? And you annualize it. How do you analyze a 10-day period? You multiply it by a factor that represents, how many 10-day periods are in a year. Say we're doing it over 30 days and it was just a month and you were going to annualize it. A month is 1/12. So you'd annualize it by multiplying it by that factor, if that makes any sense. So you take the standard deviation and you multiply it. If it was a 30-day period, you'd multiply it by that to annualize it, to turn it into a number that represents how much it would deviate in 1 year, okay? And you use this as your volatility number. What?
You're considered a long time with this stuff, or is that like a short period of time?
What do you mean?
So like when you're trying to figure these things out, right? Like, is it ideal because it's a short period of time, to look at these 1 year time scales, or like would you rather look at 10 years or 5 years or?
Yeah, that's going to change everything, right? But the whole thing is that you're picking a 10-day period, right? To take a snapshot, like a small sample, right, of the data and come up with how much it deviated, up, down, up, down, up. Next one goes way up, next one goes way down, whatever. And then you subtract and all these add up, then you do the standard deviation of all this, and you turn it into a distribution, really, and it'll show you a distribution of returns, right? But basically the volatility is the standard deviation of returns.
Okay.
Annualized, meaning like whatever period you picked to measure, you have to pick a period. I mean, it could be a year, right? But you have to pick a period. You have to annualize it. So if you pick 2 years of data, you have to annualize it back to 1 year.
How do you know what's best, like what best time period to choose though?
Yeah, that's part of that's part of you deciding what to input into the model, right? So, and so once you figured out, okay, this stock has a 20% volatility, and you might look at different time periods because obviously you have years of time where the thing just goes up like this, and then one day where it goes down like that.
Right.
Okay. And so that's a huge factor in trading, implied volatility is.
That's predictable, so it could just crash at any time.
Yeah, it could. Yeah, it could. Yeah, and prediction models are like totally different. When we talk about doing the Black-Scholes Merton thing, they talk about in terms of like Browning motion and random variables. They don't treat it as something that's predictable.
Right.
It's a probability thing. So, you know, so we take that 20% and that becomes a factor in the model as determined whether or not, you know, 115 over the given amount of time, say it's 1 year, right? In 1 year, it should have a volatility of 20%, right? Does that mean it's definitely going to go up 20% and definitely down 20%? Obviously not. It doesn't. It could very easily go up 40% and down 10%, and then up a little bit and end up still below 20%. Like it's not a, you know, it's not a linear translation. You just don't think like I'm going to start here, the volatility is 20%. That means that I'm going to be at 120.
Well, that's where the probabilities come in, right?
Right, yeah. And it's random. So when you price a call option, right, you're going to input some kind of distribution function to come up with a probability of whether or not it's going to reach and how much it could go over 115 to come up with a price on the call option. And that Black-Scholes model, that's exactly what it really is all about. Coming up with a method based on inputs, and a few of the inputs are, right, the stock price, which is S sub O, stock price. I want to mention something about the nature of volatility too. It's super important in all of these assumptions, but X is the exercise price. Exercise, X. And R, which usually isn't a huge factor unless you're trading call options that are like 2 years. The interest, risk-free rate of, the interest rate, okay? We're going to imply that we know that's a risk-free rate of interest. And then the time to expiration and the volatility. Time and V, no, that's the variance for volatility. You got a question?
Oh, no, I was just going to say, because I had a...
Yeah.
So the higher the volatility, the more expensive the options?
Yeah, you know, if you want to talk about that in terms of relative value, or like, yeah, I mean, they're going to be more expensive. They should be more expensive than a lower volatility stock.
Right.
Right.
Right. Like, so there's like a lot of expected upside and it's really volatile. Like if the stock's shooting up, it's going nuts. Those call options, the out of the money ones are really expensive.
Yeah, they're
right?
really expensive. Yeah.
And it's like a bearish outlook, then like the put options are really expensive. So
yeah.
it's almost like the market knows in a sense, right?
Yeah.
It's kind of crazy.
Yeah. Well, that's exactly what we're going to get to. So we have this mathematical equation called Black-Scholes, right? And it's a partial differential equation that's going to give me the price of a call option. You know, or a put option. Yeah, or a put, right? And the things that it uses are stock price, exercise price, interest, time, and a volatility assumption. All right? That is an assumption. You have to figure it out. And what you do is you go through and you figure out what the historical volatility of the stock is, right? For maybe a similar time frame. And you come up with, like we did, okay, 20%. It's got a 20% volatility. So then you stick it into this equation that's, you know, a little bit more than I think we can go into for sure. And you get the price of what you believe the call option should be, right? So
But it's all based off of previous time periods, right?
Yeah.
So all that probability is the probability of what happened already.
Exactly, right?
Right.
So is that a good assumption?
Well,
No,
yeah, no.
it's not. It's not a good assumption.
So even
You know?
your probabilities are incorrect.
See, the thing about this is like, it's kind of a hack, right? It's kind of like,
You're just hoping that it stays on that same constant time or that same constant like of oscillations and probabilities.
yeah, well, that's what you would assume if you were going to use 20% volatility.
They
Yeah.
win like the prize, like a Nobel Prize for this or something?
Yeah.
They win.
And the biggest thing is it kind of gives you a handle. It gives you a handle. It gives you a handle and gives you dimension and profile to the price of this call option. But most importantly, right, we know we can do some algebra, right? We know we have the stock price. We know we have the exercise price. We know we have the rate and the time to expiration, right? So what happens if we give the price of the call option as a known thing, like the stock price? Because you can go out into the market and say, well, what's the price of the call option for this stock at this size price, days interest and time. So what you do is a little algebra, and all of a sudden, you know, we have this $2 call option, right? We should be able to figure out what volatility it's implying. You know what I mean?
That's cool.
And that's
work backwards.
Yeah, you work backwards.
That's cool.
A little algebra.
That's pretty cool.
Yeah. Yeah, so that this is then the idea is that you know when you're trading options, you're not just trading, you're not necessarily betting on the direction of price. You're also taking a position on volatility. Right? Volatility goes up, the price of the options go up. Volatility is never constant. And that's the main issue with this model, is it assumes constant volatility, and because people don't read it right, it's like, yeah, you have to read the parameters. It says assumes constant volatility, you know, it's instantaneous in time, you know, every minute, right, the market changes in price, volatility changes, and your assumption would change all the time. You know, so what was so good about this model is that it turned around and said I could take the call option and dump out the implied volatility, you know. And you know, the thing about it also gave us ways to figure out, like, remember we talked about call options, right? And say the market's trading at 100 and we buy a $110 call option, right? There's a difference between the price of the stock and that's not how you spell that. Right? There's a difference here, right? So this is out of the money. You buy this call option and say you pay $2 for it, right? Well, you know, now this is not a neutral position. You're long. You remember that? Like, you're basically betting on the stock going up, right? Well, this Black-Scholes model, right, can be manipulated in a way to give you the delta, which is the difference, right?
Can you see that equation real quick?
Yeah, definitely. We definitely can see it.
Right.
You know, the delta is a partial, right? And it holds all other variables equal, and it's just going to tell you, you know, how much stock you need to short while owning this to become neutral. Okay, that means that no longer you're not long anymore. You know, so you remember that call option, right? It was like this, and here's your break-even price, and here's the strike price, etc.
To break even, you have to get 112, right, on this one, this example. That you
Yeah, probably. I forget. Yeah, on this one, you'd have to, yeah, at expiration. Okay, like obviously tomorrow, if the stock price even goes up to 103, right, the price of that call option is likely to go up. And how do you figure out how much it's supposed to, how much you think it's going to go up? It's these partial derivatives that'll give you an answer. So that partial derivative is called delta, right? And it basically tells you per 1 point change in the underlying, how much will the call option go up or down? Okay, and you can use that, right? And delta is also like another name for deltas is the underlying instrument. So the stock, when you buy, say you punch this into your Black-Scholes thing, you come out, you use the partial differential equation, you get, we need to be short 5 shares of stock. It says, we're long 5 deltas, So if you short 5 shares of stock, you're going to offset this position completely for that instant, okay? For that instant. Okay, and then when it changes, the entire delta of your position, you have 5 shares and you have 1 contract, right? You're short 5 shares and you're long 1 contract. You have 0 deltas, But now all of a sudden the stock changes, right? And it goes down, right? So what do you think? You're probably, if it goes down, right? If I think about this correctly, that means you're going to lose money in the call option and you're going to gain money in this. So you end up being more long, right? You end up being more long. And that equation is going to tell you as you go along how many deltas to share, to sell and buy based on the changing parameters, based on the change in the stock price. It's very simple. because there's other factors other than delta, right? The implied volatility could change and the price doesn't change. So that is called vega, right? And that tells you with respect to implied volatility how much this call option is going to change per 1 point change in the implied volatility. You know, if the volatility goes up 1 point, how much should this call option go up? You know? And hedging vega is like, you can't do that necessarily with your stock, but you know, when the vega changes, it's going to change the position entirely, and you're going to be long or short more deltas, right? This whole entire process is called delta hedging. Okay, so if you don't own or you're not short the stock and you buy a call option, you're long in a way. You're long. You want the stock to go up. But if you sold that, right, and you're short that call option, right, what's that mean? You know, if the price of the stock goes up, it's going to hurt you. How do you offset that? You go long the stock. Well, this entire model is going to tell you how many shares to buy to offset that short call option. You know, and that's the whole idea of, you know, this differential equation that we have not yet seen. But, you know, and that whole thing is called delta hedging, you know. And that's, for a long time, that's all people did, was they'd sell a call option and they'd buy or sell shares of stock to offset the position, right? And they'd realize a small gain, and that's the small gain. That would be like market making in options with delta hedging, you know. But that's one way to make a market in options, okay? And it's also like, you could use it in a lot of other respects. They're telling us to stop. They're watching this online? No, I'm kidding. But anyway, you know, the other thing that's so important about all this is, you know, there's a direct inverse relationship between volatility and a price of a stock. It's not, that doesn't go across the board. If you go into commodities and stuff, it might be different, right? Because shocks in the system for oil don't mean it goes down, right? Shocks in the system for lumber does not mean the price goes down. Hurricanes coming, price not going down.
Supply shocks, right?
Yeah, okay. Right. But generally, for stocks and the index and all that, you know, volatility is relatively low going up, and the door is very short going in. And then, you know, you get these days where, you know, for a year, you know, you've had these gains, and in 2 days you've lost all the year's gains, right? So, you know, by being long equities, right, your position is always short volatility. You know, you don't want volatility, right, if you're long equities.
What about volatility that takes things up? People won't usually talk about that.
Yeah, because it's not like an absolute rule, right?
Right. But
like,
usually it's volatility is.
Yeah, volatility generally has an inverse relationship.
Generally.
Yeah. So if you looked at, you know, volatility like the VIX, which is
right.
a measure of implied volatility. So there's options on the S&P 500, right, which is an index fund. And those options, they use a formula to extract out the implied volatility, Black Scholes, in reverse, and they come up with this VIX number, right? Say it's 12, okay? And it's right here, this is 12, oh, nice days, okay? And everybody's like, oh, short volatility here, and then one day it comes up and it goes to 60, okay?
Game over.
Yeah, game over. So if you're back out there shorting calls and puts, you know, you're shorting a call, shorting a put, right? And you've been making all this income all over that time, right? And all these options at expiration keep expiring worthless, and you keep keeping the credit. Because remember, when you sell a call or a put, you get a credit. All of a sudden, your earnings plus some are gone with the exponential growth of volatility. You know, it's a convex thing. It doesn't happen in a linear relationship. It happens convexly. So the price goes against you in an exponential fashion. So what you had as a vol number today, which was 20%, and the variation is really low, you're like, okay, well, hell, we're going to sell that at 22. And then the next day it goes down like this, and this is at 60, you know? you end up in a very bad position. So that's where, like, an insurance company is short volatility, right? Because they're selling you a premium, they're doing that swap of sorts. You're taking the fixed rate and they're taking the variable rate, right? If a lot of bad crap happens, they're in trouble. A change in the volatility of the marketplace will really hurt them. So they have to incorporate, when they sell a premium, they need to develop a model that includes a lot of bad things happening, So anyway, let's go ahead and take a look at that, this partial differential equation, because I was working at it today, and I understood generally what it was when I read it so many times years ago, but it's, outside of the math that I've taken. And I know Daniel's taken this level of math, but he probably doesn't remember anything. Well, at surfing he does. Right? Okay, so this is the call option price, right? And these are representative of the output of two different equations. And this is the cumulative normal distribution function. So this is like a statistic, okay? This is a probability multiplied by the stock price minus a discount factor for the, basically this is the future. This is the future, remember, because this is the excise price.
And closing the D1 is really pointed brackets, right? Is that really what it is?
This one?
Yeah.
No, it's just parentheses.
Okay.
Normal, I think so. Yeah, that's the way I copied it down. So now we look at D1. What does D1 look like? Because this is where all these volatility assumptions come in and everything. It's the natural log of the stock over the excise price minus R plus that's the variance, right? Standard deviation is the variance as the standard deviation squared, is it not? I forget. Right? Mm-hmm. Ask the statistic teacher. Daniel? 3 minutes. Oh wow, that's gonna be fast. So it's the square root of time. So we're not going to get too far on this, but there's a similar equation for D2. And I know that you're multiplying a statistic by the stock price and you're subtracting a discounted future price, which is the excise price, multiplied by the probability of that event, okay? And these events have to do with whether or not, one's a conditional probability and one's it's a probability that it's going to go up over that strike price, and then the other one is that it'll go over that strike price and by how much. And that's how you get the call, that's how you get the price per call option. I want to take a partial differential equation class just for this reason, so that I can understand it more intuitively, I've watched
Take one with Kyle next semester.
Yeah, we should.
He's taking one, right?
Yeah.
Yeah, PDEs.
Yeah.
Sorry about the phone. Someone keeps calling.
Not that it's going to do you any good. I mean, most people use this as like a black box. They give it a call option and it tells you the implied volatility, and then you make a decision whether you think those implied volatilities are high or low.
It's not based off of future, right? Because you don't know.
Yeah.
So, right.
Yeah, and I can tell you when they first started using this in the 80s that the guy that owns Interactive Brokers put all his guys out on the floor with these little computers or whatever, and they could figure out how many deltas they needed to add or subtract for their entire position, and they made a lot of money as a result because they, not everybody else was using that, because this is the deal, right? If you, remember how we talked about being long a call and short a put, right? That's long synthetic, okay? That means that this graph is similar to the stock price. So if you just short the stock, short 100 shares of stock, and you put this on, right? You definitely will never have profit and loss at all.
Equal.
Yeah, it's completely equal. Any gain in this, you lose in that. So if you had to sell a call, you could price it such that you could short the stock and short the put, sell the call for a profit, hold till expiration, and make the money. That's mainly what market makers do, because that ends up being a completely P&L less graph. So you've locked in your profit and loss right there. Thanks for sharing. I mean, for listening.